You know what nobody's talking about right now? The fact that silver just did something it hasn't done in over 40 years. And I'm not being dramatic here. I'm talking about a technical pattern that historically precedes moves so violent they reshape entire portfolios in a matter of weeks. Let me show you what I mean. Right now, as I'm recording this, silver is trading in a range that looks almost boring on the surface. You've got these tight consolidations, these little bounces up and down, and most investors are looking at it thinking, well, nothing's happening here. But that's exactly what they said in 1979. That's exactly what they said in 2010. And both times, the people who understood what was building beneath the surface made generational wealth. Here's what's actually happening. Silver just broke above a resistance level that held for 3 years. 3 years of testing, 3 years of rejection, and now we're sitting right on top of it. You know what happens when a market spends that long building energy at a resistance level? It doesn't just drift higher, it explodes. But let me back up, because there's a bigger story here that connects everything. The silver market is fundamentally different from every other commodity on Earth. It's the only metal that's simultaneously an industrial metal, a monetary metal, and a strategic resource. And right now, all three of those dynamics are converging in a way that's creating what I can only describe as a perfect storm. Let's start with the industrial side, because this is where most people completely miss what's happening. Silver isn't just used in jewelry and coins anymore. It's the most conductive metal on Earth. It's irreplaceable in solar panels, in electric vehicles, in 5G infrastructure, in medical devices, in water purification systems. Every single trend that governments are pushing, every green energy initiative, every technological advancement, they all require silver. And here's the thing that should terrify anyone who's not positioned right now. We're using more silver than we're mining. For the third consecutive year, global silver demand has exceeded supply. Think about that. We're drawing down existing stockpiles just to meet current demand. And demand isn't slowing down. It's accelerating. The Silver Institute just released their latest forecast, and they're projecting industrial demand to hit record highs this year. Solar panel installations alone are expected to consume over 150 million ounces. That's up 15% from last year. Electric vehicles, another 90 million ounces. 5G infrastructure, medical applications, electronics. It all adds up to a demand profile that's growing faster than supply can possibly keep pace with. But here's where it gets really interesting. While industrial demand is soaring, mine supply is actually declining. The largest silver-producing countries, Mexico, Peru, China, they're all reporting lower output. Why? Because most silver isn't mined directly. About 70% of silver comes as a byproduct of mining other metals like copper, lead, and zinc. And when those base metal prices are weak, or when mining operations face regulatory challenges, environmental restrictions, labor disputes, silver production drops as a consequence. So you've got this situation where the world needs more silver than ever before, and the supply is actually shrinking. That's not a recipe for stable prices. That's a recipe for a supply crisis. Now, let's talk about the monetary side, because this is where things get really fascinating. Central banks around the world are in a position they've never been in before. They've printed more money in the last 5 years than in the previous 50 years combined. The M2 money supply in the United States has expanded by over 40% since 2020. That's not inflation. That's currency debasement on a scale that would make Weimar Germany blush. And the smart money knows this. That's why central banks have been accumulating gold at record levels. But here's what most people don't realize. Silver is gold's little brother. Historically, when gold moves, silver follows. But it doesn't just follow. It amplifies. The gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been sitting around 85-1. Historically, that ratio averages closer to 60-1. In times of monetary crisis, it's dropped as low as 15-1. What does that mean in practical terms? It means silver is undervalued relative to gold by a massive margin. And when that ratio corrects, and it always corrects, silver doesn't just catch up, it overshoots. Let me give you a specific example. In 2011, when silver hit its peak at nearly $50 an ounce, the gold-to-silver ratio dropped to about 32-1. Gold was around $1,900 at the time. Today, gold is trading above $2,600. If silver were to reach that same ratio today, we'd be looking at silver prices north of $80 an ounce. That's not speculation. That's just historical mean reversion. But there's another layer to this that most investors completely overlook: the paper market versus the physical market. The COMEX, the exchange where silver futures are traded, has a fascinating structure. At any given time, there are hundreds of millions of ounces of silver traded on paper, but the actual physical silver backing those contracts is a fraction of that amount. It's like a bank that operates on fractional reserves. As long as everyone doesn't ask for their money at the same time, the system works. But the moment there's a rush for physical delivery, the whole thing breaks down. And we're starting to see cracks in that system right now. In the last 6 months, there have been multiple instances of delivery delays on the COMEX. Refineries are reporting backlogs. Premiums on physical silver coins and bars have spiked to levels we haven't seen since the 2020 panic. The U.S. Mint had to ration silver eagles because they couldn't keep up with demand. These aren't normal market conditions. These are signs of stress in the physical market. Now, here's where the strategic resource angle comes in, and this is something that's flying completely under the radar. Governments are waking up to the fact that silver is a critical material for national security. It's not just about solar panels and electric cars. Silver is essential for military applications, for defense systems, for advanced electronics that power everything from satellites to missile guidance systems. And right now, the United States doesn't have a strategic silver reserve. Think about that for a second. We have strategic petroleum reserves. We have strategic grain reserves. But we don't have a strategic silver reserve, even though silver is arguably more critical to modern technology than oil or wheat. There's been quiet discussion in Washington about changing that. If the U.S. government decides to build a strategic silver stockpile, even a modest one, we're talking about demand that would dwarf anything the industrial sector is doing. We're talking about hundreds of millions of ounces being pulled off the market in a very short period of time. And it's not just the United States. China has been accumulating silver for years. They understand the strategic value. They understand that whoever controls the supply of critical materials controls the future of technology, and they're positioning themselves accordingly. So you've got industrial demand at record highs, you've got monetary demand increasing as people lose faith in fiat currencies, and you've got potential strategic demand from governments that could enter the market at any moment. All of this is happening while supply is declining and stockpiles are being drawn down. This is the setup. This is what's building beneath the surface while everyone's looking at those boring price charts and thinking, nothing's happening. But let me show you what the charts are actually telling us, because this is where it gets really compelling. Silver just broke out of a multi-year consolidation pattern. We're talking about a base that's been building since 2020. That's 5 years of accumulation, 5 years of smart money quietly positioning themselves while retail investors were distracted by crypto and tech stocks and whatever else was making headlines. When you see a base that long, when you see a breakout after that much consolidation, history tells us what happens next. It's not a gentle drift higher. It's a vertical move that catches everyone off guard. Look at what happened in 2010 and 2011. Silver spent years consolidating in the single digits. Then it broke out, and within 18 months, it went from $10 to $50. That's a 400% move. And it wasn't a straight line. It was a parabolic explosion that left most investors on the sidelines because they were waiting for a pullback that never came, or go back further. In 1979, silver was trading around $6 an ounce. By January 1980, it hit $50. That's an 800% move in less than a year. Now, I'm not saying we're going to see that exact scenario play out again, but I am saying that silver has a history of making moves that seem impossible until they happen. And here's the thing that most people don't understand about these moves. They're not driven by retail investors. They're driven by institutional money, by hedge funds, by sovereign wealth funds, by entities that move billions of dollars at a time. And when they decide to enter a market, they don't tiptoe in. They flood in, and that's when prices go vertical. We're already seeing early signs of this. Open interest in silver futures has been climbing. ETF holdings have been increasing. Premiums on physical silver have been expanding. These are all indicators that smart money is positioning ahead of a move. Now, let me talk about something that's relevant to a lot of people watching this, especially if you're thinking about retirement, about wealth preservation, about protecting what you've built over a lifetime of work. There's a reason why precious metals have been considered a store of value for thousands of years. It's because they can't be printed, they can't be debased, they can't be inflated away by central banks. And in an environment where governments are running deficits that would have been unthinkable a generation ago, where debt levels are spiraling out of control, where the purchasing power of the dollar is eroding year after year, having a portion of your wealth in hard assets isn't just smart, it's essential. Quick aside here, and this is something I think is worth mentioning. If you're sitting on $100,000 or more in retirement accounts, traditional IRAs, 401ks, there's a way to get physical precious metals into those accounts without triggering tax penalties. It's called a gold IRA, and it works with silver too. I put together a free guide that explains exactly how it works, what the rules are, how to set it up. It's in the description below. No obligation, just information. Worth checking out if that's relevant to your situation. Anyway, back to where this market is headed, because there's more to unpack here. One of the things that fascinates me about silver right now is how quiet the mainstream financial media is about it. You turn on CNBC, you read the Wall Street Journal, and there's barely a mention. Everyone's focused on stocks, on bonds, on whether the Fed is going to cut rates or raise rates. But silver? It's like it doesn't exist. And that's actually a bullish sign. Because the best moves happen when nobody's paying attention. By the time the mainstream media starts talking about silver, by the time you see headlines about silver shortages or silver squeezes, the big move has already happened. The smart money has already positioned. And retail investors are left chasing a market that's already run. That's what happened in 2011. By the time everyone was talking about silver, by the time your neighbor was asking you if they should buy silver, the top was already in. The move happened in the months and years before, when nobody cared, when it was boring, when it looked like nothing was happening. That's where we are right now. We're in that quiet accumulation phase where the setup is building, where the fundamentals are aligning, where the technical patterns are forming, but before the crowd notices. Let me give you another angle on this because I think it's important to understand the geopolitical dimension of what's happening. We're living through a period of de-dollarization. Countries around the world are actively working to reduce their dependence on the US dollar. The BRICS nations, Brazil, Russia, India, China, South Africa, they're developing alternative payment systems. They're settling trade in their own currencies. They're accumulating gold and silver as alternatives to dollar reserves. This isn't conspiracy theory. This is official policy. China and Russia have been explicit about their desire to move away from dollar dominance. And they're not alone. Even traditional U.S. allies are diversifying their reserves, hedging against a future where the dollar isn't the unquestioned global reserve currency. What does that mean for silver? It means that as confidence in fiat currencies erodes, as the dollar's role in the global financial system diminishes, hard assets become more valuable. And silver, with its dual role as both an industrial metal and a monetary metal, becomes incredibly attractive. There's also the inflation dynamic, and this is something that's going to become increasingly important in the months and years ahead. Official inflation numbers say we're at 3%, maybe 4%. But anyone who buys groceries, anyone who pays rent, anyone who fills up their gas tank knows that's not the real story. Real inflation, the kind you feel in your daily life, is much higher, and it's not going away. The government has locked itself into a cycle of spending that can't be sustained without printing more money. Social Security, Medicare, defense spending, interest on the national debt, these are obligations that aren't going away. And the only way to meet them is to keep the printing presses running. That's not a political statement, that's just math. And when you understand the math, you understand why hard assets like silver are going to become increasingly valuable as the purchasing power of paper currency continues to decline. Now, let me talk about the supply side in more detail, because this is where the story gets really interesting. Silver mining is a tough business. It's capital intensive. It's environmentally challenging. It's subject to political risk in countries where most of the mining happens. And right now, there's very little incentive to develop new silver mines. Why? Because at current prices, the economics don't work. It costs money to explore for silver, to develop a mine, to extract the ore, to refine it. And when silver prices are suppressed, when they're trading below the cost of production for many miners, there's no reason to invest in new supply. So what happens? Existing mines get depleted, production declines, and the supply deficit gets worse. This is a cycle that feeds on itself. Low prices discourage investment, which leads to lower supply, which eventually leads to higher prices. But by the time prices rise enough to incentivize new production, it's too late. It takes years to bring a new mine online. And in the meantime, the supply shortage intensifies. We saw this exact pattern play out in the uranium market a few years ago. Prices were suppressed for so long that nobody wanted to invest in new production. Then demand started to pick up, and suddenly there was a scramble for supply. Prices went vertical, and the investors who positioned early made fortunes. Silver is setting up the same way. The supply deficit is real. The demand growth is real. and the lack of new production is real. It's just a matter of time before the market wakes up to this reality. Let me give you some specific numbers because I think it's important to understand the scale of what we're talking about. Global silver demand in 2024 was approximately 1.2 billion ounces. Global mine supply was around 830 million ounces. That's a deficit of 370 million ounces. Where did that deficit come from? It came from existing stockpiles, from recycling, from above-ground inventories that have been built up over decades. But here's the problem. Those stockpiles aren't infinite, and they're being drawn down faster than most people realize. The COMEX inventories have dropped significantly over the past few years. London vaults are reporting lower holdings. Even government stockpiles in countries that used to hold strategic reserves have been depleted. At some point, and I don't think it's that far away, the market is going to wake up to the fact that there isn't enough physical silver to meet demand. And when that happens, when the paper market collides with the physical reality, prices are going to do things that seem impossible right now. There's also the recycling angle, and this is something that a lot of people overlook. Unlike gold, which is mostly used in jewelry and investment and can be easily recycled, silver is consumed in industrial applications. When silver is used in a solar panel, in an electronic circuit, in a medical device, it's not coming back. It's gone. The quantities are too small, the recovery costs are too high, and the technology doesn't exist to economically recycle most industrial silver. So every year, hundreds of millions of ounces of silver are permanently removed from the supply chain. They're not coming back. And that means the above-ground supply of silver is actually shrinking, even as demand is growing. This is a dynamic that doesn't exist in almost any other commodity market, and it's one of the reasons why silver has the potential for such explosive moves. Now, let me talk about what could be the catalyst that finally triggers this move, because I think we're getting close. It could be a supply disruption, a major mine shutting down due to political instability, environmental issues, labor strikes. It could be a surge in industrial demand as green energy initiatives accelerate. It could be a currency crisis that drives investors into hard assets. It could be a short squeeze on the COMEX as traders demand physical delivery and the exchange can't meet the demand. Or it could be something we're not even thinking about right now. Markets have a way of surprising us. But the setup is there. The fundamentals are there. The technical patterns are there. All we're waiting for is the spark. And here's the thing about waiting for the spark. By the time it's obvious, by the time everyone sees it, it's too late. The move has already started. The easy money has already been made. That's why positioning now, while it's still quiet, while most people aren't paying attention, is so critical. Because once this market starts moving, it's not going to give you a second chance to get in at these levels. Let me give you one more historical parallel, because I think it's instructive. In 2008, during the financial crisis, silver initially dropped along with everything else. It went from $20 down to $9 in a matter of months. Everyone thought it was over. Everyone thought precious metals were done. But then something interesting happened. As central banks started printing money, as governments started bailing out banks, as the reality of what was happening set in, silver started to climb. And it didn't just recover. It went from $9 in 2008 to $50 in 2011. That's a 450% move in less than 3 years. The people who bought at $9, when everyone else was panicking, when it looked like the world was ending, they made life-changing returns. The people who waited, who wanted to see confirmation, who wanted to be sure, they missed most of the move. We're in a similar moment right now. The financial system is under stress. Central banks are trapped. Governments are running unsustainable deficits. And silver is sitting at levels that, in hindsight, are going to look like the opportunity of a lifetime. I'm not saying you should bet the farm on silver. I'm not saying you should put everything you have into one asset. But I am saying that if you don't have exposure to silver right now, if you're not positioned for what's coming, you're taking a risk that you might not fully understand. Because the risk isn't just that silver goes up and you miss the move. The risk is that the dollar continues to lose purchasing power, that inflation continues to erode your savings, that the financial system continues to deteriorate, and you're left holding assets that are denominated in a currency that's worth less and less every year. Silver isn't just an investment, it's insurance. It's a hedge against the policies that governments are pursuing, against the monetary experiments that central banks are conducting, against the uncertainty that defines our current moment. And right now, that insurance is cheap. It's available, and it's not going to stay that way forever. So, here's what I want you to take away from this. Silver is setting up for a move that could be historic. The fundamentals are aligned, the technicals are aligned, the supply-demand dynamics are aligned, and the geopolitical and monetary backdrop is aligned. This isn't about timing the perfect entry. This isn't about trying to catch the exact bottom. This is about recognizing that we're in a window of opportunity that's not going to last and positioning accordingly. The investors who understand what's happening, who see the bigger picture, who are willing to act while others are still debating, they're the ones who are going to look back on this moment and realize it was one of the best decisions they ever made. The market is giving you a signal right now. The question is whether you're paying attention.